So good. So welcome, Byron Crow and Randy Grudzinski. How are you doing?
Fine. Thank you. Thank you for inviting us out here.
Empire Group, you bet. Well, you guys have been a real solid sponsor for us and have helped out a lot of our clients. Could I get a little bit of background, Byron? Perhaps you first.
Sure. Been in the industry since 1987. So all this gray hair right here is because of a few ups and downs in the market. Background accounting, and since I've been in the investment world, I started out as a retail broker, got into capital markets, actually became a CEO of a broker dealer, and have been in capital markets with Randy at Empire for about 9 years. So the last 9 years I've been with Randy and Empire.
Very good. Randy, give us a little overview on you.
Yeah, sure. I'm a partner at the Empire Group of Companies. I have two other partners, Richard Felker and Jeff Jacobs, and Byron's very humbly, he runs our capital markets group here. A little bit about our firm, which is probably more important than me. We were founded back in the 80s, back in the Midwest in Milwaukee by my partner, Richard Felker. He moved the firm down here. Shortly after that, he always jokes that there were 1.2 million people in Milwaukee Metro and 800,000 here. And now there's 800,000 in Milwaukee Metro and 5 million here. So pretty smart move because we are a multifamily developer. We're actually ranked 4th in the Phoenix Metro. So we're the 4th largest multifamily developer, really grown the business. And if you know anything about Phoenix Metro, it just recently passed Boston as the 10th largest metro area. So it's not New York, Chicago, LA, but if you look at those next tier in terms of size of markets, we're now one of the big boys, and you're dealing with a group here that's grown to become a fairly large player in that market, and it's a rapidly growing market. A lot of people leaving California, Illinois, and New York. They're primarily going to Florida, Texas, and Arizona. Not because it's 114 degrees here in the summer, but because it's because we're low tax, low regulation, pro-growth states. And that's why, Elon Musk is moving to Texas, and Taiwan Semiconductor has $160 billion largest, project in the United States, commercial project going up just here on the north side of Phoenix. You see lots of those workers making big investments. That's correct.
All those workers need to live somewhere.
That's right. It's all about the jobs. Where the employees go, the employers go, the employees go, and where the jobs go, that's where people move. And so that's the catalyst for all the in-migration.
So in general, what kind of product do you guys make?
Yeah, thanks. It's so multifamily is a very broad term. Specifically, we focus in 2 areas. The first one I'll touch on is called single family build to rent. And as the name suggests, they're little single family cottages, but instead of for sale, they're for rent. The best way I want you to think about it is instead of 200 units on 2 acres and 5 stories like an apartment, take those 200 units, put them on 20 acres in a walled, gated, pool, amenitized community, just like you'd see in an apartment, but instead they're just little cottages sprinkled throughout. And really it's sort of the Goldilocks of housing. You want to get out of an apartment, but you're just not quite ready or don't want to go into a home. You don't want to own a place. This sort of sits in the middle. And it's a rental asset, and it's the fastest growing asset class in the commercial real estate space right now. And we're a top 3 player there. We have 22 projects across 4 or 5 states, Byron.
Yep,
20 and 5,200 units. So that puts us in definitely a top 5, but likely in the top 3 there. Then the other, and so that's more for what I'll call the Walmart crowd. Okay. The other side of our business is we build those beautiful Class A, steel and glass high-rise apartments in urban core. So downtown Phoenix, downtown Tempe, Old Town Scottsdale. And those are for renters by choice, right? Who make pretty high incomes and they want to spend $3,000, $4,000, $5,000 a month on an apartment. Some people, it's actually, maybe it's a second home for them and they spend half the year here and half the year in other spots like that. And so that's a premium renter. It's a premium product. It tends to attract people with higher incomes, and the buyers of those projects tend to be, your big New York Life, MetLife, big foreign endowments, university endowments, pension funds, so large institutional buyers. So you really have two different asset classes within multifamily, targeting really 2 different demographic groups.
Okay, excellent. And with the apartment building on its side, right? I mean, building the cottages, the build for rent. I love that idea and the efficiencies that come with that. You're still looking at the same HVAC and plumbing and tool, and the management of it must be a lot easier.
And that's what it was born out of. We one of our claim to fame here is during the Great Recession, we bought foreclosures. We bought about 2,000 homes. We at one point were the largest landlord in the state of Arizona. And we turn those foreclosures into rentals. And what we notice is it's a fantastic revenue stream. The single family renter stays twice as long. They're a little older, a little more mature. They treat the asset well. They're quieter. We love all of that. But the problem is when you own 2,000 homes spread out over a metro area of 5 million people, the HVACs are different. The maintenance of them is more challenging. So build to rent was trying to capture that same revenue stream, but do it in a more cost-efficient, scalable manner. So, 200 units on 20 acres with the same air conditioners, same refrigerators. The maintenance man walks 5 minutes from one side of the community to the other, and not an hour drive across a metro area.
Excellent, good deal. For investors in your projects, you've got, it seems you have two different ways of getting into them as well. You can either invest for income or invest for growth. Could you expand on that a little bit, please?
Sure. Byron, do you want to run on that for a little bit?
Yeah, sure. So the income units, we have Series I and we have Series G. And for all of our projects, the income units sit senior to the Series G units or the common equity. So it's kind of like when you have you own your home, the bank has the mortgage. So that's our construction loan. They sit first as far as the capital stack. Next in line would be our Series I or income units. And that varies between a 10% current pay, some are 12%. So it varies on the project. And then the common equity, which offers a potential Roth conversion, is our growth unit. And that's the last class. And they end up getting a accrual of roughly 10%, varies per project, but most of ours are 10% per year that accrues. And then there's a profit split, 60%, 50%, and some vary based on the actual offering.
Yeah, so the best way to think about it is people can decide if they want to sit senior to the common, they could buy a preferred I unit. I stands for income. And boy, that's a benefit. They get paid back first before the common equity does. And that's a sense of security. So for maybe investors that are a little more risk averse and not risk tolerant, they do something like that, but then they're limiting their upside. They only get that, whatever, depending on the program, 10 to 12% a year. But if you're willing to say, no, I want to sit in a common position, last in line to get paid back, and I don't need the current income, I'm going to let that 10% accrue, but I have unlimited upside. I want to maybe earn twice my money, right?
Sure.
And that's give or take. If you're doing a development project, you want to underwrite for your growth. Obviously, no guarantees. At somewhere around 2 times cash on cash, sometimes a little more or less. That's the trade-off. So, less return, more security, higher return potential, but less security. You're sitting in the last position.
So as financial planners, investment advisors here, we have we love tools like that. The ability to invest in something that's got a great track record, but then also it's accruing. So somebody is, most of your projects are 4 years on the average.
We think about it. We're developers. That's the important thing to remember, right? We're not buying existing assets. Typically, a construction period is around 24 months, give or take. So about 2 years on the build. If the market's really strong on the demand side, 12 months on a lease up, but I'd say give yourself 18, give yourself a year and a half. So right there, you're at 3.5 years. So give yourself a buffer in there, say 4 years end to end. And like I said, you give those modeled returns, obviously no guarantees again, but where we pro forma out, you're looking at, like most projects, you want to be in that low to mid 20s IRR on the growth side. And that's essentially where we are. On the income units, one of the benefits on the income units, though, is it's not always the case, but we just went through this with some of our build to rents. We've done it before on our high rises. Is there's an opportunity right around the time we're done with construction and we're a little bit in the lease up. If there's $1 of construction debt out there, there's $10 of people that'll lend on a completed project and take lease up risk. And usually at that point, if we create enough value, we can actually put a larger loan on, refinance the old loan out, maybe at a slightly lower interest rate, and that'll allow us to retire some, if not all, of those income units. It de-risks things for the growth units, and the income guys are great. They're like, oh, good, I got my money back, and then I could, if I'd like to, potentially reinvest in the next thing.
So from a financial planning standpoint, if somebody's retiring tomorrow, we might look more at the income funds to be able to get the income going. If they're 4 years from retirement, we might say, well, let's let that dude accrue. We don't need the extra taxable income at this point. So it really does offer some flexibility for us.
It does. And I find that the demand is, without Byron and I really having to get involved, we want to maintain about a 50-50 ratio between those two. And just the invisible hand, I find that the average profile comes out, demands about half and half. You're right. Typically, the older we have investors in their 70s, and they need just they can't deal with a drawdown, just like with the market's a drawdown, and they just they're willing to give up upside for the little more secure asset and the current income. They like that, But younger, affluent people who have a longer time horizon tend to gravitate to the growth units.
Good deal. Well, Alex, why don't you jump into Roth, skin in the game, track record?
Yeah. We talked about on the growth units, you have the Roth conversion ability. Byron, I know we've talked about that a bit. Would you mind just kind of brief overview, doesn't have to get into the weeds, but talk through how that might work and who it benefits the most?
Yeah. So we on all of our projects, the Series G units that we just talked about, the growth units, are the ones that we actually go out and get revalued. Typically, it's about when we're coming out of the project, we've spent all the equity on the horizontal improvements, and we're getting ready to kind of go vertical. We'll go to an investment bank and get those G units valued. And it's really what they are valuing those units at that point in time. Typically, we've had between a 35% discount and in some cases as much as a 60% discount. But I would say an expectation would be maybe 40 to 50, right, Randy?
Yeah, and let me explain why that is. It's important for investors to understand it. It's really just a paper revaluation. But if you take a snapshot in time, you're halfway through a construction project. You have all these non-recoverable expenses. You spent money on architecture. You spent money on all these other things. You have a huge loan, big interest reserves, whatever. If at that point in time in the middle of the project, I had to value it, that equity, it's like flying on an airplane across country. If you run out of gas halfway through and you had to value it, that plane's not going to be as valuable, right? So same thing on a construction project. So we just pick a point in time about halfway through construction and say, if I had to sell all this equity now, and there's all these non-recoverable costs, and yet I'm years away from generating positive cash flow, and they discount that back, what's the value of the equity? And obviously that value on paper, if you bought a unit at $10 a unit, it might be at $6 or $5 a unit. It's a wonderful time when you have $100,000 in an IRA, it goes down to 50. You do a Roth conversion, pay taxes at that 50. By the time we get the final certificate of occupancy, we're done building, that value is now back up to $10 a unit or $100,000, right? And then as we work our way up, and if we hit that 2x, all that run back up is all tax-free. So it's a wonderful and legal and truthful way of really lowering your overall tax liability.
In terms of the timing, this final certificate of occupancy, is there any pre-leasing that goes on, or is the leasing all taking place after the fact? Just when does that second revaluation back to,
Yeah, that's a very great. So we use a rules-based model so that we're not, if the IRS ever said, hey, what, it's like, no, we mark down the unit right around the time that we're starting. When you're doing a construction project, you spend all the equity first, and then you start drawing on the loan. So let's say a third of the money is equity and 2/3 is the loan. So about a third into, about halfway through construction, third into the project, you're going to revalue. Once we get the final certificate of occupancy, that very last unit gets approved and by the municipality, it says people can move in there. That means the project construction is done. It's at that point that we mark that unit back to its original par value. Okay. And then at that point, we typically will start, we know what the market comps are, what things are selling for. As we go from 25% lease, 50% lease, we'll start moving that number up from that $10 number up higher. And hopefully when you're 90% leased and you have good market comps and you get an idea of what it's all worth, we can have that unit value close to what it's going to be when we sell.
And we can circle back to this later when we talk about current deals, but the Central and McDowell being the high rise, downtown, are you seeing more in the direction of the Class A, the high rise style buildings in the urban versus the single family built for rents?
Yeah, that is correct. Single family built to rent is a suburban product. You think about it, it's 20 acres. You got to buy at a land basis that's sub $400,000 an acre. If we're in downtown Phoenix, you're probably paying $4 million an acre. Okay. So the reason buildings go tall is because the land underneath it is expensive. And so you got to get your land price per unit at a certain value. So yeah, the high rise thing is an urban convention, right? And the build to rent is conducive towards, I'd even say more than the suburbs. It's actually getting even further out, more like the exurbs, because you have to have a large enough plot of land to get the economies of scale. And infill suburban it's hard to find, it's hard to find greenfield, 20 acre sites or more.
Yeah, absolutely. Okay. And then as far as some of the currently live, projects that have funded and are closed and are now underway, we have Bronco Trail, Carver Mountain, Chatham Hills, Pleasant River, and Santan. Just what are kind of the updates in terms of either full cycle events or different stages of those projects? And yeah, we can do, a few of those, don't have to go every single one, but
yeah. We're not close to liquidity on any of those yet because they're just in the construction phase right now. But Bronco Trail is one of our most prominent projects just because it is the closest build to rent to the large Taiwan semiconductor plant that's getting built, literally just on the other side of the highway. To put that plant in perspective, the second largest commercial project over the last 5 years was Hudson Yards in New York at 30 billion. Taiwan Semiconductor has now been upsized to 160 billion. So it's like they're building their own city there, and we're right across the street. And it's a big project, 350 units. All the horizontal work is done. Framing, as Byron knows, is well underway. And so I don't have my sheet in front of me, but my guess is we'll open that leasing office sometime early into the new year. And get going there. It is, again, that location is, I try to love all my children equally. It's hard to find a better location than what we have at Bronco Trail. Carver Mountain is leasing up very well. That's in another area on the southwest side of the metro area. And it is, it just opened its leasing office right now. So it is moving along pretty well, and leasing's been fairly brisk there. So my guess is we'll be stabilized probably within 12 months. And so look to exit, end of 26, early 27. Chatham Hills, we recently closed the loan there. So construction is underway. They're doing the horizontal work. So again, we break it into two phases, actually three: horizontal construction, all the pipes and all the stuff underground and all the grading. Then, the vertical work, building the actual structures. And the third phase is lease up. So it's in the first phase there. And then Pleasant River and Santan as well. Pleasant River is, Byron, it's very close to opening.
Close to being leased.
It's just getting ready to open the leasing office there. The benefit of Pleasant River is that's only about 10 minutes from Taiwan Semiconductor. But our land basis there, we did a really good job of getting land at a very attractive price because we had to assemble five different buyers. And so that's, again, leasing office opening is imminent. And in Santan, all that horizontal work's done, and they're framing there as well. And I can't recall exactly, but Santan's leasing office should open fairly soon as well. Byron, I don't know if you have that.
Right at the end of the fourth quarter, end of the year, I'd say.
Yeah. But essentially, here's what people have to understand. Obviously, as developers, the only thing we can control is what we build and the quality of our team and what we lease. But a lot of the determinants of investor return are truly market related, out of our control. It's like which way the wind's blowing. For us, it's just what's supply and demand for renters, and really what's driving that. What's happened, and we're all aware of this, you read about it every day. Home prices are really high right now, and I believe they're going to probably start trickling down a bit. It's long overdue, but they're not going to be falling by 10, 20% by any means. mortgage rates are really high, and so it's really challenging for young people in particular to buy a home these days. And so because of that, there's a term in our industry called absorption. Absorption is like a paper towel absorbing water. Absorption is people absorbing apartment units as they get put into the market. How fast do they lease up? Are they getting leased up? It's called absorption. And although we've had a lot of projects, the market is right now somewhat oversupplied. There's been a lot of projects that have been built post-COVID. Absorption is actually surpassing that because people again are moving to Arizona, Texas, and Florida. They need a place to live. They can't buy a place, so they have to rent. So we absorbed last year in 2024 2.3 times, and so not 23% higher, 2.3 times as many units in 24 as we did in 23. And the first half of this year was even higher than the first half of last year. So we'll be even higher in this year. So the pace of absorption is really strong. I think it was Q4 of last year. It was the first month or first quarter in a long time where more units were leased up than were actually delivered into the market, more demand than supply. And you really see those lines crossing. Well, as an apartment developer, that's great. You want to have more demand. But what's really, and by the way, here's an interesting statistic to just manifest how hard it is to buy. 25 years ago, when I bought my first home, the average first-time home buyer was 28 years old. You will not, here we are 25 years later, it's not 34, it's not 35, 38 years old is the age of the first-time home buyer. 10 years older, and if you talk to anybody in their 30s that hasn't bought a home, they can't, or some of them have just given up on it. They just decided, I'm never going to be able to make that happen. And so that's going to be, it's a major issue for our country. Both presidential candidates talked about it last time. So you have a lot of demand because of what's going on. But then on the supply side, as rates went up, it made it very difficult and credit got tightened from lenders. It made it very difficult for small developers to actually start building more apartments. So what's happened is in order to build, you have to get a permit. Well, permits from this year to last year are down 70% from the peak. And so that is expected to continue for the foreseeable future. And so if permits are down, deliveries are going to fall. So if you want to deliver an apartment, you got to pull a permit 24 months ahead of time. So it's not surprising that next year we're only going to deliver a third of the apartments that we delivered this year. And in 27, it's only going to be a third of 26. So if you compound that, we're going to be down 80 to 90% in terms of deliveries by 2027. So it's a lot of data, but let me tie it all back together.
Well, Randy, is that,
yeah.
You said we are going to be doing that. You mean the industry or you as a company?
The industry has fallen. So at a time when we need to be building more apartments, we're going to be supplying less and less. And by the way, the home builders are even pulling back right now, as you've probably read. So where we're undersupplied by 4 million housing units in this country, that number isn't going down. It's actually going to go up. So, if you're investing with us or anybody else who's a developer, you don't really care about the market today. You care about where it's going to be 2 to 3 years from now. Wayne Gretzky said the reason he scored so many goals, he doesn't skate to where the puck is, he skates to where it's going to be. And that's what we want to do with our investors and what we do. So we care about what 27 and 28 is going to look like. And from everybody we talk to, it's supposed to be very strong rent growth because of how much supply is going to fall while demand is going to continue to go up.
Got just a couple last questions for you. I meant to ask earlier, you guys have skin in the game with your deals?
Oh, yeah. And not only do we put our own money in the deal, but one thing I like to tell them about, which most people don't realize, typically when we borrow money, let's say it's a $100 million loan, my partners and I have to post corporate and personal collateral, homes, cars, our bank accounts, whatever it is, equal to the value of that loan, right? And 10% of that has to be liquid, like in cash. So 100 million in collateral, $10 million in cash. And that's a backstop. That's what they call a personal guarantee, a completion guarantee. So I can never say we guarantee the investment, but we do guarantee that it'll get built. And those guarantees tend to bleed off when you get final certificate of occupancy. So in essence, our balance sheet is backstopping, making sure that these projects do get completed.
Well, you've got a great track record. We'll talk about that just as we close here. The 2 open projects you have right now, one of them is Central McDowell, and the other is Hyde Park.
Sure.
What can you tell us about that? This is general solicitation, general info.
Yeah, two different sides of the coin. If you like the build to rent space, we have Hyde Park, which is in Noblesville, Indiana, north side of Indianapolis. Indianapolis is, it's funny, there was a big run up in all the Sunbelt markets, and now currently right now you're seeing places like Chicago and Cincinnati and St. Louis and Indianapolis doing very well. And we really like that submarket. It's a red state surrounded by a lot of blue states. So we have basically 95% of the equity there. We have loan terms from 3 different groups. We're going to pick one in the next couple days. It'll likely be Arbor, who's one of our big lenders. And so I would expect, again, sometime between Thanksgiving and New Year, we'll start construction there. And then that's sort of a mid-sized single-family build-to-rent project just in Hamilton County, northeast side of Indianapolis, which is the most affluent area of the Indianapolis market.
Yeah. And the land seller is actually converting his $6 million into Series G units. So they'll sit side by side.
Yeah, the land cost was $6 million, and he's taking $6 million in units in the fund instead of cash because he likes the project and he wants to ride side by side with our investors. Central McDowell, again, the other side, a higher end renter, urban infill. This is our 3rd downtown Phoenix project right on Central Avenue. Central Avenue is the 0 block. It's your Michigan Avenue, like in Chicago, or your 5th Avenue in New York. It's your main street. And it's right on the light rail line. In my opinion, again, I'm biased. It's the best available piece of dirt downtown.
Well, you guys, I will say that your team has been very good, very responsive to us, to our investors, our clients. You put out some very good information. We'll have links down below on this podcast to be able to get more information. Yes. And so we'll put the track record out and the updates on the various projects that we have. So I appreciate both of you making yourselves available for this. Did you have any other questions, Alex, or anything?
Well, one cool thing I know Byron had mentioned was just the drone footage that they do on the different projects.
That's a great point. We pride ourselves. I mentioned this earlier before we started filming. The only thing that's worse than bad information or bad news is no news, right? And so we want to make sure that we don't want to give everybody so much information that it becomes so complex they don't want to read, but we send out investor updates every 3 to 4 months. They are relatively detailed. I talk about all of our projects, and included in there, which is great, is you're our partners in the project. We want to make sure you can see it. If you visit us, we're more than happy to go out and show you the sites. But if you can't, beauty of technology is we have drone links. You click on that link and you can actually see the progress on the project and visualize what it is we're doing.
So we'll do this again in about 90 days. I appreciate all the info, and we'll post the links and everything below on this podcast.
It's a pleasure. Thank you, everybody, for giving us your time and listening to us. Looking forward to partnering with all of you. Appreciate it.